Gotta stay with me. All right, good. Good boy, good boy. Hi, Peter Rose, Longwood Currency Trading. Just back from walking the bow dog this morning. It's going to be a hot early July day in 2022. I want to talk to you about the two methods of building a Forex trading position. The assumption here in building a Forex trading position is that you've got enough money to stage, okay? If you're still in the realm of trading mini lots, my advice is that you don't try to build a Forex position until you've got at least a $30,000 account, because then you've got entry and two-stage opportunities to do, and you can start to learn that process. Ideally, a position to be built would consist of a bank of, I don't know, 6 to 10 lots, $60,000 to $100,000 account in order to really effectively take care of that. Now, sure, you can take a $10,000 account and break that into 10 minis, but the point is that if all you've got is a $10,000 account trading minis, you really haven't developed the skill and the trading metrics that you need in order to effectively do these fancy things, compounding, staging, averaging, all that other kind of stuff. You really got to leave that stuff until you're into the solid 5-figure account. But you need to be aware of it now as you're building your skills as a 4-figure trader or a low 5-figure trader, so that as you're building those all-in, all-out skills, that you have the concept of why that's a good thing to do and how you're going to be able to alter that later, and you can start building your plan for that later. But I wouldn't rush it, and I've said that in other videos before. Okay, Bo, come on in. But before we can chat, I gotta have some coffee. It's a hot day. What am I doing drinking coffee? Well, I just drink coffee. I trade and I eat and I drink coffee and good red wine. It's a pretty good life. First, a couple of questions. Why are you trading? If you're in the early stages of your learning process, in other words, the folks that I'm trying to specifically address in my video channel here and in my training, is the 4-figure and low 5-figure trader who's trying to develop the skills and the confidence to be able to go and trade a 6-figure account. That's what we're all looking for, to trade that 6-figure account. And when you get more skilled at trading the low 6 figures, you get into mid 6 figures, and it becomes just an unbelievable jump. In trading one mini lot for just a 0.5% on a $1,000 account is $5, but that same 5 pips on $100,000 is $500, and on a $200,000 account, it's $1,000. You could make $1,000 a day on 5 pips if you had enough money. Now, when you're trading mini lots or low 5 figures, you have to have an all-in, all-out process, as I was saying. You go in with one full lot and you come out with one full lot. You don't fart around with staging in or staging out of the position, because if you don't have more money, it means you don't have the skill. You can make a tremendous amount of money all in, all out, but you've got to be really good at your entry process in order to do that with the higher accounts. So if I can make $1,000 on 5 pips, I could also lose $2,000 with a 10 pip stop, right? And so if you really don't have your skills down in entry analysis, that first phase of the life cycle of a currency pair, entry analysis, position management and exit methodology. If you don't have that entry analysis down really good, then when you get to the larger account sizes, you're not going to be able to effectively use one of the two staging in strategies building that position that's available because you won't understand the mechanics of the market well enough to do that. And if you try to take a $10,000 account and break that up into 10 mini lots, $1,000 a lot, and you stage two, and then you enter with two, and stage two, and stage two, and stage two, you're really not learning how to trade. What you're doing in trading those small accounts in that manner is to trade for money. But those small amount accounts are not made for trading for money. They're made for trading to learn your skills. A lot like if you were wanting to drive in the Indy 500. I've used this example before. You don't just take your street car and go into the Indy 500. You've got to gradually work your way up into not only the performance of the car, but also your ability to deal with the performance. When push comes to shove, all you're doing is pushing on the accelerator. But there's a big difference in the power that advanced car has and the damage that you can get into if you get it wrong. I'm just telling you this. I'm an experienced trader, experienced educator, and you can believe me or not believe me and watch 2 minutes of this video, and that's fine. Because most people, that's what most people will do. And that's unfortunate. Because the money you can make trading currencies when you get it right and you start working it as a business, you're not going to start a business for $500. Why would you think you could start a trading business for $500? You might be able to learn on that, but if it's less than $1,000, what are you learning? You're trading for pennies. Oh, I made 22 cents today. Terrific. How about making $22? That would be much better. And you could do that on a $1,000 account trading one mini. It'd be 22 pips, right? Dollar pip. Now, the two methods of building a Forex position, given the fact that you have a large enough bank to break up your trades, is to either have a static staging in process of trades of trades into that position. Maybe you're going to do that every 5 pips as the price advances in your direction. The other method is to take into consideration a little bit more complex problem, which has to do with the average position price, which changes each time you add a trade to the position. If you open the position with one lot, your average price is, let's say, 1. And then at 5 pips, you add 5 more lots. So now you've got 5 times 5, you've got 25 plus 1, 26, divided by 6, about 20, something like that. 2.5, 3 pips is your average. And you're at 5, and your average is 3. So one little tiny barf of that price will take you below the average and put you into negative territory to the tune of 6 pips, or 6 lots, right? Let's reverse that. You open the trade with 5 lots, and at 5 pips you stage in 1. Now you've got 5 plus 1, you've got 6, and you divide that by the same 6, and you get a little bit over, or you get 7, so you get a little bit over a pip and an eighth or something like that as your average, but your price is at 5, so you've got almost 3.8 pips of runway before you'd be in danger of having that price go negative on you. You see the math? I'm not going to draw it out for you on a bulletin board. Supposedly, you are bright enough, if you're watching this part of the video, that you can do this kind of thing. So when you're not using a standard pip-based ladder of building the position, you do complicate things a little bit. But what that complication does is buy you more money in the end. Because the idea is to front load as many lots as you can and then stage in less and less as you go up, which means that your average price climbs up very slowly in relationship to where the actual current price is. And that gives you the ability to have much more discretionary decision-making power in determining when to exit that position. Maybe you want to give it 8 pips of pullback before you decide to get out. Well, if you front-loaded your lots in the beginning in the first 8 or 10 pips, and now you're up at 20 pips, and you're going to come back 8, you know, you're at 12, and you're going to make 4 pips on whatever you've staged in. So although the the number of pips that you make might be small in relationship to where the price was, you've got more lots, which gives you more money. If you reverse pyramid that and enter the trade with 1, stage in with 2, stage in with 3, stage in with 4, stage in with 5, that's an upside down pyramid. You're growing the base up here. It doesn't take but a fart to bring that price down to wipe you out. So hopefully you know that much about it, even if you're not trying to build positions right now in your trading. Look, I'm going to repeat this in almost every video that I say. If you're not trading with a large account, if you're not trading with $30,000 yet, it means you haven't survived all the things that you need to survive in order to be confident enough in yourself to risk $30,000. If you're not confident in yourself enough to risk $30,000, then why are you trying to do advanced stuff down with 2 mini lots or 5 mini lots? And I don't care what these educators out there that are telling you to do. It's wrong. It's not educationally sound. It's fraught with problems. Could you get away with it? Sure, you can get away with it. Any dumbass, like my stockbroker used to say, it's like even a blind pig in a snowstorm can find an acorn if he looks long enough, right? That's not the point. You'll lose all your money long before you find that acorn. And so I have to keep harping that on you, and not to get involved in this stuff, but to plan for it. Same way you would if you were trying to build your car from a street car into a car that could participate in stock car racing or track racing at a high level. So the 2 methods of building the position are going every 5 pips you add a lot. And I wouldn't say that if you're going to use a static position like that, I wouldn't say that you should put a lot of lots on the front load a lot of lots and then drop that a little bit and then drop that a little bit and then build from there. If you're going to do one methodology, do one methodology until you get good enough to do that third form, which I'm going to discuss now, which is that not the laddered staging, but incremental size staging. If you go in with a big size at entry and you lose, you've lost that. If you have a good win-to-loss ratio, it might mean that that win-to-loss ratio in trading the smaller accounts has been that you're averaging 8 pips, let's say, on a win. So if you've got a 10 pip stop loss and an 8 pip all in, all out average win, you're going to win. You're going to be okay. Even a 60-40 trader is going to probably be okay on that. Not by much. 60-40 is the bare minimum trader that you should be at before you move up in your bank size. This is all covered in the courses and consulting and stuff that I do. And don't call me and ask me how much it is and all that kind of crap. It's really expensive. And if you're asking me how much it is, you're really not interested in learning how to trade. You're interested in how much it costs. Go to Udemy for $49.95. You can buy 16 modules and learn all about what a fucking pip is and how to scale your bank. I don't do any of that in my training. I'm not going to insult people that are looking to trade a six-figure account, and they're just looking for the way to be able to do that. When you have those two major methodologies of incremental staging and ladder staging, you can break that incremental staging out into the decision process of how big do you want that entry position to be. You want it to be large enough so that if it only gets to that, let's say, average 8 pips, you've at least made a good price on the trade. If you lose with that entry, you don't want to have it so big that you have to struggle with the winning trades in order to not only break even, but to make a significant amount of money. If you're talking about a 60-40 trader, that's 10 trades. At the end of 10 trades, do you want to have come out of that by winning 2 pips per trade? Even though you might have won 20 pips at the end of the month, let's say you traded, and at the end of the month you had 20 pips. Well, you know, that's great. But if you look at that on a per trade basis, it's 2 pips. So in the event that you run in to the statistical 6 losses in a row, or you just do stupid shit, or you listen, like I said, Ed, the little bridge troll that sits up on my left shoulder and whispers in my ear to do stupid shit. If you have one of those little bridge trolls on you and you have a series of losses and then you push it and you have a 20 pip loss one time, you're going to be in the hole big time. And it's very difficult to dig out. It's easier to dig out of the hole when you have a large account, but it's not so easy to dig out when you have a small account. If you're interested in the rationale that comes out of real estate theory, and I'd be happy to do that as part of a consulting program or something. But the key issue in your staging is what's that first position look like? And I think that's a function of how big of a bank that you have and how many standard stage in positions do you want to plan for, and how many over profit target staging positions do you want to have left. For example, if you have a profit target of 20 pips and you're trading 5 lots, and you get all those 5 lots staged, let's say you stage 3 or 2 at the open, and then you stage the other 2 from your entry to 10 pips, right? And that thing goes to 20, you've done really good. What if you sense that that move is going to go beyond 20? Wouldn't you want to stage in not just 1 lot, but wouldn't you want to stage in 2 or 3 because your base position is lower from the average value of the position, because you've waited until you've got them all staged in, and now you're up at the 20. So you could stage in maybe 3 lots there, and wouldn't bring up the average position value into a danger zone where you would go, oh my God, I've only got 3 pips of breathing room or 5 pips of breathing room, right? So you'd want to have some extra dry powder in order to stage in beyond that profit target. How many times would you want to stage in beyond that profit target? Well, you'd want to have as much dry powder as you could, because you don't know how far that position's going to run. I got out of a position the other day because I thought it had run its course, and it ran 60 pips further. I didn't get back in because I had made plenty of money for the day, And I just thought, there's so much volatility here that getting into a new position is far different than riding that position further with an already established low average position cost. So I didn't do it. And I don't feel bad about that. I made good money. Made $900, $800 or $900. And that was a good return on the size of the bank that I had at that particular time. I was happy with that. You can't let your greed overrun your fear. And I was very fearful when the price got to the level that it got to, and I just said, there's a lot of volatility here, and it could go, but it's staggering right now, and if it flipped around, I could lose 80% of my accumulated profit just like that, and so I'll take the profit now and see what happens. Well, you see why I'm constantly harping on all the experience, the trading experience that you need to have trading that 4-level account. That's the most important time you're ever going to spend in your trading, learning process. I can't help you trade a high 5-figure account or a mid 6-figure account if you don't have good fundamentals. Any more so than I could teach you how to drive a race car if you just were getting out of your little Kia, 2-door Kia, family car, okay? There wouldn't be any purpose in talking to you. You're going to kill yourself, and you're going to kill everybody else on the track around you. In currency trading, the only person you're going to kill is you, and I'm not going to be there for you to blame and say, well, you told me to do this, you told me to do that. Well, yeah, but I got to make the assumption that if you're doing what you're doing or trying to do what you're doing, you already have a good, solid base. But most people don't. Yeah. I had a student one time worked with, and he was able to take these small accounts and double them. He was taking horrendous risks. He wasn't doing the right thing, and he'd lose his account, and then he'd go and he'd double it. I said, you've got to stop this. Well, I can't make any money that way. Well, you're not supposed to make any money. Be happy with $5 or $10 a day on one mini lot. He not only lost that mini account, he lost 2 more of them. Maybe he just didn't listen. I'm tired of working with people that don't listen. I spent over 50 years. I started martial arts in 1968. That's how long I've been in martial arts. I've had a lot of students, and I demand their attention and their performance to do what I know is best and safest for them. And when I get a student that wants to argue with that process, I tell them to go get another instructor, because I'm not going to work with them. Or because of my belligerent attitude about, look, you're going to get yourself in deep shit if you don't do this. If you don't practice it this way, if you don't do it this way, you're going to be in deep shit. They don't want to hear that. So 5 or 6 or 8 year student, they don't want to hear that. They think they're better than that, really. Our entire lives are driven by hope, fear, and greed. Learn to channel that properly so that when you get to the point where you're faced with the ability as an account size to learn how to build your positions rationally, you know what the 2 major forms are, and you know what the subform and its problems of the incremental staging part, and you can build yourself a trading plan, maybe with your experience, if you've done it right, and if you had some good instruction in how to learn and build your trading plan from a framework. You'll be successful at it. But if you just think that you're comparing apples and apples when you jump to trading that 6-figure account, you are mistaken. And so be very, very careful about that. Do a lot of thought process before you jump your size from even a $10,000 account to a $30,000 account size. If you lose the $10,000, you can recover from that. And you're not going to lose $10,000. You know, margin, if you're in the U.S., as I've said many times, margin is 5% of the cash value of the position at that particular time. So if you're trading at 1.2000, and your margin is 5% of a $120,000 position, right? So it's $6,000. And so that's why the 10,000 is important, because your margin is 6 and it leaves you 4,000. Okay? So $4,000 at $10 a pip is 400 pips. So you could lose 400 pips at $10 a pip before you ran out of money. That's a lot of time to make errors and mistakes. But hopefully you've already done that in your $1,000 account, and you lost your $400 there, and you learned what not to do, so that when you get the $10,000 account, you don't have to lose the $4,000 in order to make that $10,000 grow to $15,000 or whatever you need it to grow to in a year, right? And when you are able to consistently grow your account, you are now ready to find as much money as you can possibly get your hands on, put it into your account, and start learning how to build positions. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.